right, 4 days in a row now to the upside, but there's some red flags emerging. So I'm going to share with you what those are from a technical perspective. Not a warning to necessarily not be bullish, but it's suggesting that this might not be the beginning of a new multi-month run. And we'll talk about what's kind of emerging and why that matters. And we'll also talk about what's driving this action, as we always do, with our trade idea at the end. So let's go ahead and get started. Today is Thursday, February the 6th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast indicator on the S&P 500. Like we always do, we'll look at SPX here, and you can see we've had a fourth day of gains and another day. In fact, you can kind of see a little bit of a trend. And I've talked about this in a tweet about how each one of these days that we've rallied here, let's actually go back to SPY so we can see the gaps. Each one of these days that we've had, look how small the bodies are. So the bodies represent, here's the close on Friday, here's the open on Monday. So all the bodies are all of them are up. They're all open bodies, which means that we closed higher. In this case, we only closed 7 cents higher than the open. But you can see the bodies have been getting kind of progressively smaller, which means the range between the open and the close, obviously between the high and the low is bigger. That's what the whole candle is. But between the open and the close is getting smaller. So we haven't had a whole lot of movement throughout the regular trading session. All the movement, if you go from 321.73 all the way up to 333.98, so that is about a over $12 difference. Most of that $12 gain didn't come during the regular U.S. trading session. It's coming overnight in these gaps. And remember, the volume is relatively low as it is during these days, because we get more volume on the down days than the up days. But the volume, so if I look at the volume here on the 3 green arrow chart, and I'll come back to this here eventually, but you can see here's the 4 days of volume. It's been progressively smaller, but also keep in mind that the volume for the overnight trading session is extremely small, way down below those levels. So very, very minuscule. Most of this $12 plus move that we've had in these last 4 days has occurred on extremely light volume for SPY. So keep that in mind. And the other thing too that we talked about in our portfolio management class today, if you look at the dollar index, these same 4 days, and we're down a little bit here today, but these same 4 days that the S&P has been up this week, look at the dollar. The dollar in those same 4 days has started, we pretty much have continued a new intermediate run that it's been on. In fact, if you look at the 3 green arrow chart, or excuse me, the 3 green arrows, you saw that we had the 3 red arrows there. But if you look at the market forecast chart for the dollar index, you can see we had light pink shading and a yellow line. It's not right on top of each other. And then boom, 4 days, we've bounced back up on this intermediate run. We're coming off of a cluster, an overbought cluster we don't get very often on the dollar, and we've broken through some of these highs over here. Very bullish sign for the dollar. That's not typically a bullish sign for stock. So a couple big red flags about this 4-day rally that we've had. Now it's a 4-day rally and you can't disregard that. But the fact that we rallied so much, so fast, in a short amount of time with the dollar rallying, we rallied so much without volume, and again, extreme amount of volume compared to the regular trading session's volume, extreme low volume. And then you have these 4 really strong days on the dollar, which is not, dollar and stocks usually don't go hand in hand. And you can see the movement there that lasted throughout. Again, the dollar is traded throughout the day. You can see it's already trading now for today's session. That's another red flag in terms of how bullish we are going forward from here. The near-term line did get in the upper reversal zone. The momentum line's popping back down because of the smaller ranges, but the near-term line did jump to bullish territory, so we could get a bullish near-term run. The question is, without an intermediate pullback, without breaking through this 23% level, have we had enough of a run to say, okay, now we are starting a new intermediate rally? That's the question. Is this an intermediate low point where we can start a new 1 to 3 month rally out of this? Or are we just going to get at most maybe a week or two of a near-term run out of it to a divergent high point, because you wouldn't expect the intermediate to form a higher high here, so it's more than likely going to form a lower high. Is it going to be a divergent? It's already going to. We know it's going to be a divergent high because we're already up to higher highs as it is. That's the question, and I believe we're in the latter camp rather than the former. I don't believe that this was an intermediate low point that sparks a new. We didn't even get a red line. We didn't get dark pink shading or red line, one or the other, much less both, which is what you typically need. Few things you need to get a good intermediate pullback, and that is dark pink shading and a red line, or more than a 23% retracement, or typically more likely both of those things. And we haven't got any of those things yet on this pullback. So that's why I don't think this is an intermediate low point, and I think that we're more likely heading up to a divergent high point. A divergent high that still could last a week or so, because of the near-term line making a hard jump into that reversal zone. You can see with the Russell 2000 not going up to new highs yet, so it kind of shows how not bullish we are, and actually had a bearish candle here today. So it kind of throws another little pail of cold water on this rally that we've had. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching this on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon that's down there too. That will let us know that you liked our video today, that you want us to do it again tomorrow. Quick way to give us feedback. You can do that right now while you're watching. Also down there, comment. What did you get out of the video today? We're always interested to see what you got out of it. Join our website at marketscholars.com for free. There's a link popping out at the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook community or Facebook group that we've created. All right, if you're interested in following up on the trade ideas that we do in these Market Outlook videos, we do that in these Market Outlook live videos. We follow up on all of our old trade ideas all the way to the time that we close them. We also put on today's trade before the market closes. So we do that 3:30 Eastern time. If that's something that interests you, check that out. Again, that's part of our monthly subscription plan. Our premium subscribers get it too. But both our monthly and our premium subscribers get access to that class. With our plus subscription, the monthly subscription, you also get access to all of our trading rooms. There's a few of these that are coming up. Our Q&A sessions here are only for our premium subscribers. So that's one thing. Engage with us on social media here. Click on this little heart. It opens up this window. You can like the Market Outlook tweet there. Click that thumbs up. It takes you to your Facebook page. You can like today's Market Outlook Facebook post. Again, you get the benefit. When you do that, you get a benefit. It ensures that Facebook and Twitter will promote our content to the top of your timeline, so you don't miss out on anything we put out there, because they promote stuff that you engage with the most. We benefit from it because all of our followers, they will promote the content to all of our followers, people who follow our accounts, because it's engaging content. It's been liked and retweeted. So we invite you to do that for us there. All right, now let's head back to the charts. And when you look at the weekly chart that we got going on here, you can see that we're back, just 1 week of a bearish candle, we're back to a bullish candle, but look at that long upper shadow. So we're getting some choppiness here in this, retracement zone, like on top of this retracement zone. A little bit of a higher high, as you can see. Obviously, this is a Heikin-Ashi candle, not a regular candle. But you can kind of see too that's not the most bullish candle. It's got a long lower it's got a lower shadow and an upper shadow, whereas your typical bullish Heikin-Ashi candles only have the lower or the upper shadows. They don't have the lower ones. So keep that in mind. Not as bullish as it appears there on a long-term basis, at least. Let's look at the 3 green arrows. Of course, we're back right on the 3 green arrows. In fact, when you look at the 2-line versions of these, you can see they both back up above their moving averages, but they've got some serious ground. I mean, we already got higher highs, and they've got some serious ground to make up to form higher highs themselves. Otherwise, that's a divergent high, which again is, something to keep an eye on, because even when you look at other oscillators like the RSI and the CCI, you can see they're also setting up for divergent high points. So big a little bit of a red flag there in terms of how comfortable would you be to chase this move and or use it instead to take risk off, because we got higher prices now to take risk off. That's a good thing. So there's going to be a lot of people chasing this because they think, oh, here we go again. We're going to get a new move off at this low like we did back here or even back here. And the reality is we haven't had the exhale enough to produce a new inhale. And if we do get a big inhale out of this shallow exhale, the eventual exhale is going to be a lot bigger than what we really want it to be. All right, now let's take a look at the intraday chart today. And you can see all these gaps, the moves. There's the gap that hasn't filled in yet. There's a gap that hasn't filled in yet. There's a gap that hasn't filled in yet. So you got 3 gaps, and today's gap mostly filled in. We started up higher, came down, and then we really went sideways. About as small of a trading range you could possibly get. So we've really, like, this whole move, and that was all, a fourth of it was that is move. But we are above a support level. We got a new high tag. In fact, if you look at because now you have the high and the low tag within the last 4 days. Just kind of keep in mind that is, if you look at the Arun indicator here, there's the high and the low both up above 70. It's not too common to get them both up above 70. This right here, right here you had the negative up to 100. And the high was at 84. You had them both above 70 there, and then that led to the decline. Now, this is a little different story here because the low hit 100. The low is not at 100 right now, but it is at 78. Here's another time where you had them both above 70. Again, the low. Over here, the low didn't quite get above. I mean, this is a very similar picture, actually, in March of 19 to what we got right now. A little different in terms of, like... here we go. There it is right there. So in fact, it's very, very similar to what we see here. You got a period of volatility out of this, some up and down choppiness, and then a leg higher before boom. And that was, this intermediate rally. That intermediate, and this was all in, when was this? The March the 13th. So if you look at the market forecast here and you go back then, you can see that the intermediate, the bullish intermediate run really started right there where the green line turned higher. The intermediate line crossed up above 50 in this area. That was middle of January. So we were 2 months in by the time. There it is right there, the light pink shading that occurred, and then the subsequent bounce. Actually, this one, it was the first light pink shading and yellow line that occurred, and then the subsequent bounce. The difference this go around is that we've already had that move. We've already bounced. That's the difference. So a little bit of a concern in that regard, that since they're both so high now, the issue is when you have the high tag over here and we form a new low, and it's gonna look how fast we moved in 4 days. It probably won't be in a day or two, which is kind of what you would need to keep the high tag up above 70% and then get the low tag up to 100, which would be the new. Obviously, that's when it formed. That's when it hit 100 right there. It was a few days ago. You can see if I were to go to the Arun indicator, we hit 100 came pretty close to 100 right there. On the negative line, and obviously getting back up on the green line, it kind of shows you where we're at. But that was our when you get these both up there, that's your sign that both your high and your low tag are on this side of the chart. You might say, well, the low tag, it never did get to 100 on that day. That wasn't the down day. Well, that's the low tag that came into play on this day because one of these other lows that was below it came off, and so that's why you see the red line jumping up above, but not jumping to 80 because we weren't hitting the low on that day. We're continuing to go higher here, so not the most bullish of patterns to have them both here. Eventually it does lead to that intermediate pullback, but it might not lead immediately, as we saw in that example. It didn't quite lead immediately. We had a little bit of a run. I don't think we'll get that much of a run this go around, and if we did, we'd be 5 months now, and the last time we had a 5-month intermediate rally was not a good ending for stocks. It'd be the January of 2018, the end of January 2018. All right, finally, let's look at the VIX here. And you can see it dropped a little bit below 15, and it dropped a little bit below 95%, but not back below 90. So dipping its toe a little bit into the neutral zone, but not enough. You can see last time we dipped our toe in the neutral zone after a bounce, we bounced back up again. So, another sign that we're not quite out of the woods yet and starting a new intermediate run yet. I showed you the volume was lighter, below average at 50 million. Today's trading range is obviously smaller. We don't have... you can see the close 332.86, the low was 332.80, so we filled in the gap from that perspective. So we had a one less than 1.5 point range, 1.39. So when you put that number into context here, 50 million is way down here at the bottom. 1.39 is off the chart in terms of where the ATR actually is. Obviously well below 1%. So it shows again that we're not falling off a cliff. We might not be forming a new intermediate low point and taking off here. We're also not falling off a cliff either. And there's a good chance that any additional weakness we get would be kind of similar to what we saw over here, where it's just choppy. It doesn't really fall down. Things just get pretty choppy in that regard. All right, so what do you think with that assessment? Again, bullish posture, bullish intermediate posture. Nice, good bounce here. Probably not the beginning of a new intermediate run. More likely the beginnings of a near-term run that will ultimately produce divergent high points, and then that intermediate pullback, which might take another week. It's a process. To get an intermediate pullback, it's a process. It's not a one-day event, as much as we like to think it should be or could be. Not a one-day event. So what do you think about this assessment? Do you agree or disagree? Click that link. It opens up a poll. Hit either one. If you hit disagree, comment down below on what you're seeing. Not just your opinion, but what's driving your opinion on why either you're more bullish or that you're more bearish than I am. All right, when you look at what's driving this price action here from an asset class standpoint, you can see, interestingly enough, during this pullback, risk-off environment, crude oil's bounced up a little bit here. Emerging markets have been bouncing up for a while, and gold and treasuries kind of bottomed out, or peaked, on Friday, and everything else kind of bottoming out. Crude oil bottoming out a couple days later, but you can get the idea. I mean, merely big, important pattern on crude oil the last few days, to the point where it's like, okay, is it going to get above this 52, which would nullify this fake out, this breakdown below that support level? You can see where the support lies, and you break, over here you can see what happens when you get a fake out on the resistance side of things. We come down pretty hard. Resistance fake outs and breakouts are significantly reversal patterns. So if this ends up being a fake out, then we take off. If not, if we hold resistance here after the kind of return move after the support breakdown, we make a return move and continue to go down. And in conjunction with that, if crude oil continues to go down, you can see its bearish candles. But if the yields also continue to go down and they make their way towards a divergent low point, like we've mentioned before, that would obviously be bearish in the short term. But as I mentioned today in class, like yields are at levels where you would expect a pretty decent bullish run on equities and a bearish run on the dollar. And the dollar, as bullish as it is right now, there's expectations that that it's starting this intermediate run, and when the dollar itself goes on intermediate rallies, like the one that we're on, this one here, this one over here, this one, of course, this big one coming off of early November 18 low, April 18 low point. So those moves where the dollar had strong moves to the upside didn't exactly coincide with strong moves to the upside in equities. They kind of went up, and usually by the end of the dollar's intermediate run, equities really tapered off to the point where they lost all their gains. So it's not bullish for the dollar to be moving higher, and obviously that's the situation right now with commodities and yields both extremely low and, as of right now, moving lower. Looking at the calendar here that we have coming up, the big news tomorrow is the employment situation. So all eyes are going to be there, a little bit on the wholesale trade, but mostly the employment situation. So we'll keep our eyes on any revisions the previous months, what impact that will have. The Yardeni research here, the indexes they show the economic surprise index. It's up to almost 40. So these economic indicators have been progressively getting better, and you can see it's expected to show some improvement in there. Expected to show some improvement in wages, wage growth. So things are starting to improve, and so I don't expect this intermediate pullback and risk appetite to last too long. But because of that, the overall macro picture is bottoming out. Things are showing some signs. And like I said, the jobs number next week will be or tomorrow will be the big news. You can see how dominant the U.S. has been. It continues just to outpace all these are all the other 12 major economies, and they're all lagging behind. Brazil was doing well at one point. Russia was doing well at one point. South Korea and China were up here too at different levels. They're all falling off to the point where China dropped down to the lowest level, and there was South Korea. India is down there. You can see Japan as well. So all these major Asian economies obviously impacted negatively, and the dollar really coming out. And we've seen this picture before where the dollar really outpaced for mostly, or S&P really outpaced in 2018 and 2019, and you know, those really from the high point that we had, like really in October of 18. We haven't, I think what I saw today, we had a 7% return over a 2-year period, annualized return over a 2-year period of time since that October peak, before the big drop that we had in Q4 of 18 and the whole year of 19. So keep that in mind. That, you know, that's where the S&P really outpaced these international stocks for an extended period of time. And you can see that's kind of what we're having right now, and that's usually not the greatest thing. From a 6-month perspective, you can see there's also has not been an outperformer, which is bullish. It's bullish, and you know, for it not to be the high beta name, but it is now. Korea is doing okay; it's holding up, but yeah, it's not good for the dollar to be the outperformer among all these major economies here, as we've seen in the past. All right, from a sector standpoint, if we take the same look at the sector chart. Over that same 3-month period, you can see technology, communication services really showing some relative strength to the upside, especially technology, the big outlier. You can also see healthcare holding up. It's had its ups and downs. You also see utilities holding up. So the utilities have been an underperformer, but it's really taken off here. Real estate to a small degree, materials and energy to a small degree as well, energy giving back. But you can see the energy losses that we've had down 10%, really pretty much from in the last few weeks. It's a significant decline. In fact, if you just look at the 2-week period here, then you can see utilities were holding up really. I mean, were the outperformer, and now we're starting to get these cyclical areas doing well this week, including technology. In fact, just looking at just this week alone, right, because that's where everything has kind of started here. So just looking at Monday, coming off of Friday's low point, just this week alone, you can see materials, healthcare, technology, all sorts of different areas. On the other end of the spectrum, look at utilities flat, staples, real estate flat, energy lagging behind with consumer discretionary. So a little bit of a bullish risk on, and some not so bullish risk, you know, missing some things that you would expect. To help, especially considering communication services and consumer discretionary, two strong cyclical sectors, big weighted cyclical sectors. You'd expect them to be up here as well. So for our trade idea of the day, I want to take a look actually at the industrial sector. And the industrial sector really during the pullback, if I were to go back a little bit further during this pullback here, and let's see how far we do need to go back. To where things peak. So it looks like things peaked here from a risk-on standpoint right around the 24th. So we'll go to the 24th. and take a look at during the pullback itself. So right there. Utilities have been holding up. You can see technologies held real estate staples. So those aren't surprising. On the flip side, to the downside, by the time we hit this low point, industrials was one of the biggest losers. Healthcare had pulled back some. Communication services, two previously strong sectors. Material sectors also pulling back, and energy, not surprising with strength in the dollar. Now you can see 4 days in a row this dollar's been really strong, and we've seen how that's functioned. Technology really taking off. Discretionary starting to move higher. Communication services lagging behind with their interest rate sensitive components and rates being as bearish as they are. So I want to take advantage of that weaker sector, and the industrial sector continues to be relatively weaker. One thought that kind of stood out to me today, it looked better at the earlier in the day when I was looking at it, and then at the end, because we had a cluster briefly, is this deer. And you can see it is a long lower shadow. We do have the light green shading. We don't have a yellow line yet, but that would be your sell signal. And sometimes you don't get that when you're really early, like you can see you get a light pink shading you don't necessarily get, and that turns out to be a pretty good signal. Just the reverse of that signal. When you look at it on a long-term chart here, you can see that we're kind of flirting and messing around with the 200-day moving average as the PPO works its way down to the downside. From a 3 green arrow standpoint, we are below the 30-day moving average. It's crossed back above the 17. They've crossed below the moving averages. We are bearish enough to see whether or not we get a new leg. I actually expect a new leg lower to the downside, partly because you can see the Ichimoku cloud remains to be, we're below the cloud. We got up above the blue line, which is a sell signal. This is a sell signal to be bearish. Despite the rally, we're still showing a bearish trend on its trend quality indicators. You look at the DMI, despite the pullback or the rally, the negative index is still above 25 and the positive index is still below 20, where you want them to be. And then finally, when you look at the Bollinger Bands for deer, you can see that we're flirting with the top end of this volume node that we're on, acting as a resistance level with the point of control in there that we hit up against a couple days ago. So now the question is, are we going to break through? And obviously there's another resistance above that. And the question, especially if we get more of an intermediate pullback, would be no. If you take a look at the trade that we did, or plan on doing, is to sell the 155 put and buy the 160. You can see 155 is easily within a 1 standard deviation move. We put a half a normal position at risk with our position sizing, and we go for about a 4-to-1 reward to risk ratio. In the worst case scenario, or 8-to-1, if we can keep our our loss to half of what we're trying to make. So another way to reduce my risk in my active trading portfolio by adding a little bit of negative delta. It's not a lot of negative delta, especially when you beta weight it to SPY. So it's not a lot, but it's something, and it's some extra bearish to reduce what is still relatively bullish inventory right now. All right, well, that does this for tonight. Again, you've heard from me. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. It opens up a forums where you can comment on anything that we talked about in today's video, or reply to anybody else's comments. And let's keep this conversation going in our community. Remember to follow me hit that thumbs up icon, comment on our video down below, and subscribe to our YouTube channel. Follow me on Twitter for more content in between these videos, and join our community at marketscholars.com, as well as our Facebook group that we've created. Have a great rest of your Thursday evening, everybody, and we'll see you all next time.